Hello, welcome to Economics 231. This is Chapter 6 video lecture. There is no video quiz for this chapter. Instead, we have an Applia assignment, and maybe we'll do a little bit of that during the lecture to show you how to do it. I'm Dr. Yohe, Gadsden State Community College. Now, this lecture is on monetary policy. Get this to work. There we go. Okay, and in this chapter, we'll discuss how monetary policy affects the economy through the money market and what are differences between Keynesian and monetarist policies. Okay. Having a little technical difficulty here getting this thing to switch. There we go. Okay, when we talk about money, we're going to talk about the supply and demand for money. Like everything else, money has a supply and demand. The demand for money is composed of different components. The first thing we're going to talk about here is the transaction demand for money. And that is the stock of money people hold to pay everyday predictable expenses. Okay? So people will hold money to use for their daily transactions. Okay? It's pretty self-explanatory there. The other types of demand for money, the first one here is a precautionary demand for money, or the next one, excuse me. And this is the stock of money people hold to pay unpredictable expenses. Just to give you a simple example, when I was a grad student, I had this horrible car I bought for $900. And I worked for Southern Union State Community College, and they had a campus in Wadley, Alabama. And if anybody's ever been to Wadley, Alabama, it's especially going from Auburn, there's no interstate. It's all on state roads and highways, and it's very rural. And I was always worried that my car would break down on the road up there and out in the middle of nowhere or whatever. And at the time, it was $50 for a tow. I knew that because I had to get that car towed once. So that increased my demand for money. I used to keep $50 extra in my wallet in case, right, this unpredictable event or expense occurred where I needed my car towed. Because I always wanted to make sure I had $50. And sometimes, believe me or not believe me, as a grad student, I didn't. So I wanted to make sure I had $50 cash on me in case the car broke down. So that would be a precautionary demand for money. There's also something called a speculative demand for money. And this is the stock of money people hold to take advantage of expected future changes in the price of bonds, stocks, and other non-monetary assets. So one example for this is large companies, okay, or investors, excuse me, big mutual funds, large investors, banks, okay, individuals will say, oh, I think that the market is getting ready to crash, or I don't know what's going to happen in the market. It's too much uncertainty. So what people will do is they will hold cash. They will sell their stocks and turn it into cash. That way, they believe the market's going to go down. They won't get stuck with assets that has their price decline in terms of dollars. So you say you sell the stocks hopefully high, right? Say at $100 a share, and then the market collapses, or you have a recession or stock market collapse, and then the stock sells after the collapse for $80. I sold my shares at 100. The stock dropped down to 80. I can go back and buy back those shares if I thought it was a good company and just happened to go down during a stock market crash or something. So that's the speculative demand for money. Okay. You expect future changes in the price of bonds, stocks, or other non-monetary assets. So if I think stocks are going down or bonds are going down, I'll pull my money out of the market and hold it as cash because I'm uncertain about what's going to happen to asset prices in the future. Okay. Now, a change in interest rates has an effect on speculative demand. As the interest rate falls, the opportunity cost of holding money falls, and people increase their speculative balances. So if the interest rate falls, say the interest I could get on a bond or on a CD or something, investing my money falls, the opportunity cost of holding cash decreases with it. So as interest rates fall, people will hold more cash for speculative demand. So if we want to go back here, excuse me, there is an inverse relationship between interest rates and the speculative demand for cash, all other things being equal. If interest rates go down, all other things being equal, that will increase my demand for cash. If interest rates go up, all other things being equal, that will decrease my speculative demand for cash. Okay. The demand curve for money is a curve representing the quantity of money that people hold at different interest rates, ceteris paribus, all other things being equal. Okay. Interest rates affect the demand for money because there is that inverse relationship between the quantity of money demanded and the interest rate. So here you can see that the speculative demand for money at different possible interest rates, excuse me, I'm going to go back here, gives this curve a downward slope. And we already did this, but here you can see a decrease in the interest rate will increase the quantity of money demanded. An increase in the interest rate, which makes the opportunity cost of holding cash higher or money higher, will cause a decrease in the quantity of money demanded. So here we have the demand for money curve. On the x-axis here, we have the amount of money that people demand, okay, that they want to hold. And then here we have the interest rate as a percent. And you can see here, as interest rates go down, the quantity of money increases. Interest rates are on the left-hand side. The amount of money, and I can't move this. There we go. That people want to hold is on the right, the x-axis here. So as interest rates drop, you can see the amount of money that people want to hold increases, and this is the demand for money or money demand. And this is the demand curve for money. So we've got half the story here, you can see here. At a 4% interest rate, individuals want to hold $1,000 billion, that's actually $1 trillion in money. As the interest rate decreases from 4 to 2, you can see here, that people's demand for money increases from, the quantity demanded increases from $1 trillion to $1.5 trillion. These are in billions of dollars. So 1,000 billions is a trillion. 1,500 billions is 1.5 or 1.5 trillion. So you can see here, as the interest rate drops, the quantity of money demanded increases. Now, what determines interest rates in the money market? This is the market for money. The demand and supply of money in the money market determines the equilibrium interest rate. So we have the demand for money. If there's more money at any particular time than individuals demand, they will use those in this model to buy bonds, or they'll buy a financial asset with it. As people buy more bonds, that causes an increase in the price of those bonds, and the interest rate falls. So the way that a bond works is, it's typically some par value, we'll call it $1,000, okay? Now, that par value doesn't mean much, except when we calculate the interest paid on it. Let's say we have a bond that pays 5% interest per year, once a year. The way we calculate the interest payment is you take the par value of the bond, $1,000. You may have paid more for it, you may have paid less for it. That's different. Par is $1,000. And if the bond pays 5% interest, you take per year, you take 5% of $1,000, and that would be $50 in interest payments every year, usually paid at the end of the year. So, that interest payment doesn't change when what people pay for the bond changes. So if people buy the bond at $1,000, they get a 5% per year return if they pay the same price for the bond as the par. But if interest rates go down, say from 5 to 4% on that type of an investment, that's going to cause people to want to buy those 5% bonds when everything else is selling at 4%. So more people, and that would be because of a decrease in the demand for cash maybe, or an increase in the money supply. So people are going to say, I don't want to hold all of this money. I'm going to sell some of the money and buy assets, in this case a bond. As that increase in the demand for the bond occurs, that causes the price of those bonds to increase. As the price increases, the interest rates that investors receive from the bonds will decrease. You still get the $50 payment, but instead of paying $1,000 to buy the bond, now I'm paying $1,010 for the bond. That's going to cause the interest rate I receive on the bond to decrease. Okay, so excess money demand. People demand more money than is available on the market. They will then sell bonds in exchange for cash. As they sell bonds, that increases the supply of bonds while decreasing the supply of money on the market. And that will cause the bond prices to fall, and that causes interest rates to go up. Remember, we said 5% times $1,000 par is $50 in interest payments. As more people demand cash and offer to sell their bonds on the market, that causes a decrease in the price of the bonds, say to $900. But the interest payments stay the same, so I'm receiving $50 a month, but instead of having to pay $1,000 now, I only had to pay $900 to buy the bond. That's going to increase the rate of interest we earn on the bond. So we'll use the calculator to show you that. Only take us a few seconds here. Oops, that's calendar. I got the wrong one. Close that. Calculator. There we go. So here, I'm receiving a $50 payment. I'm going to divide that by the price of the bond. So here's a $1,000 bond. You can see here 0.05 is the interest rate on that bond. Now, when the price of the bond drops to $900, I still have that same $50 interest rate because that's based on the bond. That's 5% of par, $50. But now, the price I pay for it is only $900. The interest rate that I'm receiving on that bond has gone up from 5% to 5.5%. So when there's excess demand for money, when people want more money than is available on the market, excuse me, they will go out and they will sell bonds and that will cause bond prices to fall and interest rates to rise, and that will in turn decrease the demand for money. Okay, we've explained this. I'm going to go on from that. Okay, here's the equilibrium interest rate. At any one time, the money supply is fixed, so that's straight up and down. In this case, $1 trillion in money is available. Here's the demand for money. The equilibrium interest rate is 4%. If interest rates went up to 6%, you can see here, that would create a surplus of money. At 6% interest, people demand less money than is available on the market, and that's a 250 billion surplus here. Okay. If interest rates are too low, that would create a shortage of money. At 2%, people demand $1.5 trillion in money. There's only $1 trillion in money available on the market. That creates a shortage. People demand more money than there is money available. That would cause them to sell bonds. As they sell the bonds, the price of those bonds would decrease, and that would cause interest rates to go up. And as interest rates go up, the quantity demanded for money decreases and brings us back towards equilibrium. The opposite occurs if we have a surplus of money. Here, at 6% interest rates, more money is on the market than is demanded. There's a surplus. Nobody wants this money at 6%. They want bonds at 6%. So they will buy bonds with that excess cash. As they buy bonds, that causes the price of the bonds to increase, and that causes the interest rates to decrease and brings us back towards equilibrium here. So the market will adjust if we have too high or too low of an interest rate and bring us back towards equilibrium. Now, this is something that's very important to us lately, and that is how can the Federal Reserve influence the equilibrium interest rate? The Federal Reserve is the central bank for the United States, and they can create and destroy money through buying and selling bonds on the market and pulling the cash that they receive for those bonds off the market when they sell them, and that would decrease the supply of money, the red line back here. Okay, so if the Fed were to sell a bond, they sell it to you, you pay money for it, that money gets destroyed, that would shift this money supply curve to the left. On the other hand, and this is mostly what central banks do throughout their history, is they don't want to destroy money, they want to create it. So they would instead, if they want to create money, they would buy a bond. They would create money out of thin air, bank reserves that eventually become money in the banking system, and buy a bond from a bank, increasing the money supply when they buy the bond. It's a nice gig if you can get it, creating money out of thin air. Most of us call it counterfeiting. Okay? So the Fed can increase or decrease the supply of money. If they increase the supply of money, that causes a money surplus and people will buy bonds. And that will decrease the interest rate. So when the Federal Reserve wants to decrease interest rates, they increase the supply of money. As they do that, that puts a surplus of money in people's bank accounts that they don't want. So they will then use that surplus in money to buy more bonds, to buy bonds, put into bond markets, and that will cause the price of the bonds to go up and the interest rate in the economy to decrease. So here's a graph. Here's our money supply before the Fed acts, and interest rates are 6%. Then we increase the supply of money. The Fed goes out and they buy bonds from the public, putting cash onto the market. That increases the supply of money. That creates a surplus of money. There's more money at 6% interest than people are willing to hold. So that creates a surplus, in this case of $500 billion. People will start to use this surplus money to buy bonds, increasing the price of the bonds and decreasing the interest rates in the economy, and bring us to a new equilibrium here at E2. Okay? In this case, that surplus is eliminated by falling interest rates. If they decrease the supply of money, that creates a money shortage, and people will sell bonds for cash. As they sell bonds for cash, that will cause an increase in the interest rate. This increased supply of bonds on the market causes their price to fall, all other things being equal, and that will cause an increase in the interest rate. So here we have an initial money supply of $1.5 trillion. Here we have money demand at an interest rate of 4%. This market's in equilibrium. Everybody who wants money at 4% interest has it. Then the Fed decreases the money supply. They pull $500 billion off the market. That creates a $500 billion shortage of money. People want $1.5 trillion still, demand hasn't changed, of money at this 4% interest rate. But the Fed has pulled $500 billion out of the market. That causes a shortage. There's this much money, but people want to hold that much. So they will go out onto the market and sell bonds. As they sell bonds, that causes the price of those bonds to decrease and increases the interest rate that they receive on those bonds. And as interest rates increase, they get to 6%. This market goes back into equilibrium. Everything stops in essence, because at 6%, the amount of money that people want to hold is exactly equal to the money supply, and everybody is in equilibrium. So you can see here, if we decrease the money supply, that causes interest rates to increase. So we have an inverse relationship, all other things being equal, between the supply of money and interest rates. If the Fed wants to decrease interest rates, they will increase the money supply. If they want to increase interest rates, decrease the money supply, all other things being equal, assuming that the demand for money is constant. Here, it doesn't change. That will be it for this first video. I have to keep them short. There will be another video to follow. Thank you very much.